Okay, so this was the problem, right? What you were asking. Question number 5 from the test your knowledge. I believe this is the question. Yes. So hope all of you have got the study material. Test your knowledge. Question number 5 on this uh, holding subsidiary group related things relating to EPS. Hope all of you got the question. Let us read it. Calculate the subsidiaries and groups basic EPS and diluted EPS. Parent company profit attributable to ordinary equity shareholders 12,000, excluding any earnings or dividends paid by subsidiary, ordinary share outstanding, instruments of subsidiary owned by parent, 800 ordinary shares, 30 warrants exercisable to purchase the shares of subsidiary, 300 convertible preference shares. Subsidiary profit 5,400, ordinary shares outstanding 1,000, warrants 150 exercisable to purchase the ordinary shares of subsidiary, exercise price 10, average market price 20, convertible preference shares 400, convertible into ordinary share, dividends on preference shares 1 per share. No intercompany eliminations or adjustments were necessary except for dividends. Ignore income tax. Also ignore the classification of components of convertible financial instruments as liabilities and equity, or classification of related interest and dividends as expenses and equity required by Ind AS 32. So first we'll calculate the basic EPS as far as the parent is concerned, subsidiary is concerned. Then we'll go for dilutive EPS, and then we'll come to the group basic EPS and dilutive EPS. Institute has given some solutions, but we'll look at that later. Okay, so let's calculate maybe in a columnar format basic EPS, dilutive EPS for holding company, separate financial statements. Then we'll come to subsidiary. Then we'll come to the consolidated financial statement. Okay, so holding company, they have profits 12,000. Holding company alone. So we are not doing any consolidation here. So holding company alone, separate from statements, I will take only their profits, which is 12,000 divided by number of shares 10,000, 1.2. And holding companies don't have any convertible preference share, right? Yes, there is a warrants and preference share, that is investments. They are investing, they can convert, the shares belong to subsidiary company. So holding company don't have any convertible preference share, any options, so they don't have any different dilutive EPS. The same only 12,000 by 10,000, 1.2. Coming to subsidiary company, let's do the basic EPS. They have profit of 5,400, ordinary shares of 1,000. This 5,400 is profit, and we have convertible preference shares. And normally, preference shares will assume you have to pay preference share dividend. You can assume this amount is after preference share dividend as well. The question is not specified. We can assume that this 5,400 is after preference shares dividend. Then you need not subtract. Because when you say earnings available, it should always be available to equity shareholders. So 5,400, from that number, I'll subtract 400 into 1, right? 400 preference shares, 1 rupee dividend. So 5,400 minus 400, which is basically preference share dividend, 400 into 1, divided by number of shares. Number of shares of subsidiary company, thousands. So 5,000 by thousands, 5 per share. Okay. Now relating to dilutive EPS. Now dilutive EPS means what to be considered? This profit earning available to equity shareholders is 5,000. Now that I will increase by potential shares. Potential shares, we have two things. One we have regarding the warrants, other we have regarding the convertible preference shares. So when preference shares are converted into equity shares, the preference share dividend you will say, how much dividend? 400 rupees. The preference share dividend you will say, effectively it becomes 5,400. Could have taken directly 5,400 also, but what is our process? Existing profits, incremental profits are added, incremental profits are added, and denominator incremental shares are added. And what is regarding the options? Regarding options, we don't get any incremental benefit, right? The warrants, options. So incremental benefit is zero. We don't take that anything into consideration as far as warrants is concerned, option is concerned. So zero is what usually take regarding options or warrants. Divided by number of shares existing thousands plus preference share dividend corresponding number of shares. So how many preference shares we are going to issue? Each convertible into one equity share. So 400 only. So we'll divide by 400. Plus regarding the options exercise, that is the warrants. What is the benefit? Unlike right shares, as I told you, we are not going to bothered about impact on you see adjusting factor, theoretical ex-right price. We are not going to do those things regarding warrants. Warrant is just the concession. What is that concession? Issue price 150 and the fair value excise price, sorry, number of share is 150, excise price is 10, and the market price fair value is 20 rupees. So what is the concession? Concession is 20 minus 10, 10 out of 20 rupees and multiplied by 150 shares, correct? So can I do like this calculation if it is not too much? Here if I show the calculation, it is 20 rupees minus 10 out of 20 rupees multiplied by number of shares 150. Effectively I get 75 shares. If I consider entire this one, I'll get 75 shares. 10 rupee concession out of 20 rupees into 150, that's basically 75 shares. So numerator 5,400, denominator 1,475, 1475. So 3.66. 3.66. So this is the dilutive EPS. Regarding the basic EPS, dilutive EPS for holding company, subsidiary company. Now come to consolidated financial statements, basic EPS. how much earnings we should take? The holding company's profit plus the profit receivable from subsidiary company, holding company share. NCA share will not come here, only holding company share. So how much will be the holding company share profits if I calculate? Okay. Uh, 12,000 is the holding company profits. Holding company profits 12,000. And how much shares you are having? 800 ordinary shares you are having. Out of how many shares? 1 second. The parent company is having 800 shares out of 1,000 shares. So can I say 80%? So 80% of, hope you're able to get it, 80% of what is the shares, profits attributable to subsidiary company. Subsidiary company profit is, I can say 5,000. 80% of 5,000. Effectively 4,000 you get. There is one more way in which you can get this number. What is that one more way? How many shares the holding company is having? They're having 800 shares. And what is the earnings per share of subsidiary company? 5 rupees. So 800 shares, number of shares held by holding company, EPS 5 rupees. This also will give you 4,000 only. Same answer you get 4,000. 80% of subsidiary company profit. That is, remember, post acquisition profits. Holding company column, NCA column. Post acquisition profits 4,000, 5,000. 80% in ConPL, balance 20% goes to NCI. Or directly you can take a number of shares is 800, EPS 5 rupees. You are eligible for 4,000. Directly you can take. And this 400 also there, right? Out of this 400 also, you are having some portions. How much portion? Don't take 80%. How many shares the parent company is having? They are having 300 preference shares out of 400. So percentage wise, can I say 75%? Correct, 75%, right? 75% because 300 out of 400. 300 preference share out of 400. So preference share wise, you are having 75%. So 75% of the preference share dividend 400, 75% of preference shares dividend, which is 400, 300 I can take. Or directly also I can do. How directly I can do? How many preference share having? Preference share I'm having 300. What is dividend per share you're eligible for? 1 rupee. 300 into 1 rupee. Directly you'll get 300 into 1 rupees, 300. So 12,000 plus 4,000 plus 300 divided by number of shares, thousands. So tell me how much you get. How much you get? 1.63? Yes, 1.63. Okay. So you have observed, instead of going by this percentage method, going by per share basis method is more convenient, right? Number of shares you have multiplied by corresponding basic EPS. So when we go to dilutive EPS, I will choose that method. How much of profit we have, numerator what I'm going to do, I'll multiply it by the respective EPS by number of shares. I can get a faster answers. 10,000 shares, consolidated 10,000 share, correct. 10,000 shares. I hope 1.63 is correct. Yes, 1.63 is correct. So here what I'm going to do, when I'm computing the dilutive EPS of the group, I will take the profit existing 12,000 of the holding company share. That 12,000 will increase. What I'm going to do, I'll do the per share basis approach instead of percentage approach. What is per share basis? Like the way I did here, you have 800 shares and each share will be worth how much? 3.66, right? So 800 shares into 3.66. Or I can do one thing. Total number of shares I will add. How many equity shares you have? You will get 800 equity shares. Or I'll do one by one also. You will understand better. So 800 into dilutive EPS is 3.66. Number of shares multiplied by corresponding dilutive EPS. Otherwise, you have to add that number and take a percentage. You should calculate revised shareholding and all. Rather than that, this is faster. Plus, you are having how many preference share you are having? 400 preference share, and in place of 400 preference share, you get 1:1. So 400 equity shares only you get 1:1. So 400s multiplied by 3.66. Those 400 preference shares also will become equity shares. 300 shares. How 300 shares? Oh, 300 shares. Oh, 300 preference share. Correct, correct. 300. 300, not 400. You are having 300 shares. Correct, correct. You are having 300 shares. Preference share, the holding company is having 300. Correct. 400 is total. What we are considering is only what a group is holding. Perfect. 300 preference share, but that 300 preference share becomes 300 equity share. And each equity share is valued at 3.66. And you're also having options. How many warrants you're having? 30 warrants. But should I consider 30 warrants entirely? No, take only the uh, bonus element. What we considered while computing dilutive EPS. What is the share we have considered? It is 150, right? In whichever ratio you can apply, you can apply it. One method, 30 out of 150. Can I say 1/5 or 20%? So 20% of what is this number we had here? 75 shares. So 20% of 75 shares, 15 rupees, 15 shares. You can analyze like that. Or what you can do, 30 warrants you are having, how many equity bonus element you get, which is having impact on dilutive EPS. The concession is 10 rupee out of 20 rupees. 10 rupee excise price, 20 rupee issue price, concession is 10 rupees. So 10 rupees out of 20 rupees. So 1 by 2, 10 out of 20, out of 30 means 15 shares. Either way, any way you calculate, it will come to 15 shares. 15 shares into 3.66. Only this 15 I'll show somewhere here. You can do in two ways. You're having 30 into 20 minus 10 divided by 20. That's how you get 15. The same process what we applied here. Same process. The concession divided by the fair value multiplied by the number of warrants. That is the number of shares you're likely to receive. Bonus element. Or you can also say 75 is out of 150, and how much for 30 warrants? You get 15. 15 multiplied by 3.66 divided by total, which is same, divided by 10,000. You can do total also actually. 800 shares plus 300 shares plus 15 shares. Then multiplied by 3.66. Or what else you should do? This revised number of shares divided by total shares of subsidiary, the percentage of share capital, then apply it on the profits numerator. It's a long process. Per share basis is faster. So 800 plus 300 plus 15 into 3.66 plus 12,000 divided by 10,000, I think 1.6 something, 1.61. Okay, so that's all about this problem. Let me know if you have any doubt. If it is fine, then shall we go further? I hope it's done. Any other doubts? The only thing what you have to learn in this problem is from the group point of view, instead of applying a percentage of share capital on profit, it's easy to apply number of equity share into corresponding EPS. For basic EPS, number of share into basic EPS. For dilutive EPS, potential shares also into dilutive EPS. Hope it is clear. Go further then.